I want to welcome everybody. This is the videos for adjusting entries, and we're just going to go over the basics of adjusting entries on this video. In the next video, we'll actually be doing some of the work on how to do the adjusting entries. Some of the types of adjusting entries we're going to be getting into, we'll cover in here so that it'll make sense for the next one. The accrual basis of accounting is what we use. That's why we have adjusting entries, because revenues are recorded when you've earned them, and expenses are recorded when they're incurred, not when they're paid. And that's different than the cash basis. The cash basis is revenues and expenses are recorded when they're actually paid or when you receive the cash. Okay, like we talked about before, there's three types of trial balances. We did the unadjusted trial balance already. Then we're going to do I have just as trial balance, but it's also called the adjusted trial balance. That's done after the adjusted entries are made. And then the post-closing trial balance will be done later. Okay, the unadjusted trial balance lists all the accounts, and some of the accounts we need to adjust because of the passage of time. Okay, types of account required adjustments. Accruals. That occurs when revenue has been earned or an expense has been incurred, but you have not recorded it yet. Okay, if the accrual is revenue, what they mean is you have done the work for them, but you haven't billed them yet because it's not due, or you've completed the work and they haven't paid it yet. Okay, but generally it's not billed yet because that's why it's not on the books yet. So you need to record what you have actually earned at that point in time. And an accrued expense is the same type of thing. It's things that you have had happen that you've encountered, such as wages or labor. They've done work, but maybe they get paid on Friday. Well, this is Wednesday, so you owe them for 3 days of work, and that's an accrued expense. And then deferrals, that's the other type, is if that's revenues that they've paid you ahead of time, but you haven't earned it yet. Okay, that would be like subscriptions to magazines. You bought them ahead of time, so the magazine company has an unearned revenue account until they send you the work. Or insurance is another one. You pay it ahead of time. I don't know of any company that lets you buy insurance as you need it. So that's the type of revenues that you have. Those are deferred revenues, and deferred expenses would be the same type of thing. It'd be like utilities expense. Those are deferred because you don't get billed for them until a month after you actually receive use the utility or the power. So those are done after the fact. Okay, accrued revenues. Here's an example of one. Some revenues are recorded only when the cash is received. At the end of the accounting period, if there are revenues earned but not yet recorded, like you did work for somebody, then you would debit the accounts receivables and credit the fees earned account or some type of revenue account. The accrued expenses, like I said, is wages. People have worked maybe 3 days and not paid till Friday, or maybe withhold a week. So you have wages expense and wages payable. And then you have deferred the unearned revenue and revenue would be an adjusting entry. That's for something that they've paid you ahead of time. I gotta start over. Dang it. I'd like to welcome everybody today. We're going to cover adjusting entries today, what they are and why you have to do them, and the types of adjusting entries that we may have. Because remember, what we're doing is the accrual basis of accounting, which means we report revenue when it's been earned and expenses when they've been incurred. Unlike the cash basis, which is reported when you receive the revenue, the cash, or you pay out the expenses. So we're going to do the accrual basis of accounting. Okay. Now the adjusting process, we have three types of trial balances. The unadjusted trial balance, which we covered. The trial balance, sometimes also called the adjusted trial balance. That's the main one we're going to deal with. And then the post-closing trial balance, which we'll do later, and that's to make sure everything's okay. Okay. The unadjusted trial balance lists all the accounts. Some of the accounts have to be adjusted. And the reason why they're adjusted is because time has passed, which means you've earned things or you've had things expensed out that were recorded differently earlier. Types of accruals. There are two types of accruals. One is accrued revenues. This is revenue that you have earned, but you may not have billed yet because it's not due, because you're not completed with it, but you have earned part of it. Okay, maybe you're working on a contract for somebody, or you're working on a building and you have part of it done. So you've earned part of the revenue, but it's not done yet because you haven't billed them yet because it's not completed. Okay, then you also have accrued expenses. These are such things as wages. The reason why you have accrued expenses is because they have performed the work for you, but you haven't paid them yet. And part of the reason is it just may not be due. For instance, on wages is one I like using because it's easier to understand. You may have worked 3 days, but they don't get paid till Friday. Well, if Wednesday is the last day of the year or the last day of the month, well, then you've earned those, they have earned those 3 days worth of wages. So that's an expense for you that you need to report for that current period. Remember, we report them in the period that they're incurred, not when we actually pay them. So that's an accrued expense. And then you have deferrals. You have deferred revenue. This is one that they pay you ahead of time for work to be performed. Okay, maybe you're a supervisor and you're overseeing an office building. Well, they pay you ahead of time. Insurance companies have deferred revenue all the time because you buy insurance ahead of time. And as time passes, that deferred is used up. It's no longer deferred or not for future use. Then you have deferred expenses, which are ones that you buy ahead. You may have paid ahead of time. Like if you're the company that bought the insurance, you would have a prepaid account. Those are deferred expenses. And as the months pass, those get used up. Okay, so that's the type of thing that we're going to deal with. Like I said, we're going to do some examples later. Okay, accrued revenues. Okay, this is work that you perform for somebody. Maybe you're an accountant and you're doing somebody's taxes and you're halfway finished with it, or 3/4 the way finished with it. And the end of the month comes, or end of the year comes. You do it, you finish it up the next year. Okay, maybe some bookkeeping things you've done or whatever it may be. But anyhow, you haven't billed them yet because you're not completed with it. But you'd still set up the revenue that you've earned at this point in time for the work that you have done. So that sets up an accounts receivable and fees earned. And I just made up the number 3524. Okay, so don't worry about where the numbers come from. That's just the account you would use for that. Accrued expenses is the wages. They may have worked for somebody. You have some people working for you. They've done work for you, and you haven't paid them yet because it's not Friday. So that would be an example there would be wages expense and wages payable. Those are accrued expenses. Deferred revenues when they pay you ahead of time. This is when your original entry was be to cash and unearned revenue. Now the adjusted entry is you've earned it, you would debit unearned revenue because unearned revenue, remember, is a liability. So that would be a debit because you want to reduce the unearned revenue, and then rent revenue would be your credit or whatever revenue account. It could be insurance revenue, service fee, whatever it is $9,600. Again, I made up the numbers, so don't worry about it. But this is when you get paid ahead of time. They may have paid you for 3 months rent ahead of time, and you've earned 1 month of it. Okay, deferred expenses is when your original entry is prepaid insurance. You debit prepaid insurance, credit insurance expense as the original entry. But then as you use the insurance expense, you have to expense it out as use the insurance. So you would debit insurance expense and credit your prepaid insurance. Okay, depreciation is another one. It's kind of off by itself. This is one where it doesn't take any. It's because what you're doing is expensing out the cost of the machinery or the equipment or the building, whatever you're expensing out, because it's not a part you're paying for the building. This is how much of the building or how much of the equipment you've used up. Okay, and there's various ways of doing it, and for our purposes right now, it'll be pretty much given to us. So we would debit depreciation expense for office equipment, office building, whatever and then credit accumulated depreciation for the office equipment. It's whatever we're depreciating, or office building, or whatever it is. And we said it was going to be $500. Okay. The depreciation expense is on an income statement. The accumulated depreciation goes on the balance sheet underneath the asset that it's being depreciated, and that's called a contra asset account because it's subtracted from the account right above it. Okay. Here's how I show you it works. So office equipment is $5,000 less accumulated depreciation of $500 gives you the $4,500. Then is the book value. Okay, the book value is an asset. Cost minus the book value equals the cost minus the accumulated depreciation. Now, accumulated depreciation is called that because it accumulates every year. If we're doing this $500 every year, then the second year there would be $1,000 in it, or the second month, whatever the time period is. But it would increase by that amount every year, every time period. Whereas the depreciation expense would actually start over, which we'll get that into closing entries, because that is an expense account. Now, you also notice on these adjusting entries, we have to have one income statement account and one balance sheet account. Okay, for instance, on the first one, accounts receivable is a balance sheet account. This is an income statement account. Wages expense is an income statement account. Wages payable is a balance sheet. Unearned revenue is a balance sheet account. It's a liability. Rent revenue is an income statement. And same way, insurance expense is, of course, an expense account, which is an income statement. And prepaid insurance is a balance sheet account. Okay, so every type of entry has those. And depreciation expense is an income statement. Accumulated depreciation is a balance sheet. Okay, then here's some other things that we have. Land does not depreciate, because the way if you do depreciation is basically what we want to do is cost minus the residual value divided by the useful life. Well, land, we don't know what the useful life is. And so that's why it cannot be depreciated. So far as we know, it's indefinite. Okay. Then there's some equations you also need. Return on assets is net income divided by the average total assets. The debt ratio is total liabilities divided by total assets. Profit margin is net income divided by net sales. And current ratio is current assets divided by current liabilities. So that should take care of this video. And like I said, next one's going to actually take the journal entries and how we actually do the journal entries for it. So look forward to hearing from you or seeing you next time, and hope this helps.